State bank ஒரே இன்னைக்கு ஒரு ஸ்கொயர் ஃபீட் கிடையாது. பங்களா ஒன்று இருக்குது பெண்டிங் எல்லாம் செஞ்சு புதுசாக கட்டிட்டாங்க.
ஒரு நியூஸ் பண்ணுங்க. செகண்ட் குமார் சார் பேசுறாரு, பட் இங்க வரல.
Morning. Narendran sir, வணக்கம்.
சார் வணக்கம். பட் நீங்க பேசுறது இங்க இதுல கேட்கல.
Okay. For the Zoom members it will be audible. So it's fine.
சார் ஒரு நிமிஷம் சார். சார் ஒரு நிமிஷம். இங்க ஏதோ வயர் கனெக்ட் பண்ணுவாங்க. Sir, shall we ask him to proceed? இல்ல சார், குமார் சார் பேசுறாரு. Shall I ask him to proceed? Kumar sir, you can go ahead, sir.
So, thank you. Morning, the members present here, physically as well as virtually. And at the outset, I am very happy to introduce our senior member, Sri Narendran sir. He needs no introduction, absolutely. It's not a formality. He is extremely known to all the members and he's been practicing for more than 15 years in Salem as well as in Tirupur. So he is always a friend, philosopher, guide for all of us, and he has been supporting the members as well as students at all the time. I would probably say Narendran sir is like Nilaya Vidwan in All India Radio. Sir, thank you so much. With this very few words, I will leave the stage for you. Thank you so much.
Thank you, sir. Shall we start?
Sir, you can start.
Yeah, thank you, sir. So, hope கேக்குதா sir? So, first of all, I thank our management committee for giving us the wonderful opportunity to interact among the members regarding the certain gray areas in accounting standards. And I personally thank all the senior members who are physically present here to encourage us to make our presentation. I still remember Prabhakaran sir was my Sikasa chairman when I started my career as a teacher in the branch in the year 2003 and 4. So thank you, sir, for coming and encouraging. And I'm also given to understand that we have few participants attending this meeting or Zoom call. So just we'll go ahead. Today's morning speaker, Mr. C. Manivel, he started beautifully with the theme why this FRRB has been found by ICI and explained us how cautious we have to be while finalizing a financial statement. So normally as a professionals, we are all more concerned about our income tax and the GST, but many of us don't give much of attention to the accounting standards, because majority of the accounting standard accounting entries what we pass comes day to day. So we feel like we are more comfortable in it. Wherever the accounts are going properly, when accounts are being maintained properly, there will not be any issues in accounting standards. But if any adjustments has to be done, so it has to be done in line with what is being given in various statutes. If those things are fitting within the statutory limits, yes, we can go ahead and we can do it with a confidence. So similarly, one of the main gray areas in every business concern is accounting for the closing stock of an inventory. So whenever the client wants to either increase the profit or if he wants to decrease the profit, the first head where they will keep their hand is where they will think is about keeping the hand in inventory. So when an inventory is being reduced, there should be a proper justification. So if you are going to do an ad hoc reduction in the valuation of inventory, so normally the management will suggest, sir, we'll keep this much of inventory so that we'll declare this much of profit. But without any justification, if you are going to accept it, then tomorrow the businessman will come out safely because you know how to manage it. But we are bound to our disciplinary committee. It's going to be a tough task for us if you are not going to follow the proper method. So as Mr. Manivel rightly pointed out, in AS2, two methods only has been recommended. One is the FIFO method, another one is weighted average method. So even if you want to help the client, we have to ensure that those things are within the ambit of law. If it is not coming under the ambit of law, we have to educate the client that you are also under the risk if you are going to sign it. But I don't know how many of your us are keeping it in mind. Generally, whenever the closing we are doing, if at all we want to increase the profit for the purpose of bank, or if we want to decrease the profit for the purpose of taxation, the first thing that comes to our mind is we see what is the closing stock we have. So probably we may be doing a lot of non-corporate audits, so which those cases may not be referred to FRRB straight away. Probably if some problem comes maybe through an income tax department or a GST department where those officials feel that the inventories or any other items in the financial has been undervalued or overvalued or not presented properly, and if they take a stand to refer the case to the FRRB, then it will be a problem for us. Yes, we have to help our client. The same way we have to save our skin also. So majority of the cases wherever we appear for the physical scrutiny, we had a chance to explain the cases and get the confirmation of the assessing officer. But now everything has become faceless. We don't know who is going to do the assessment, who is going to do the scrutiny. And if you have come across the latest notice which have been we are receiving from the tax officials, they are very clear. They have been trained very properly. They have been called for some in some places. They have been given proper training, and the questions what they are asking is, for example, in case of a closing stock, they are asking what is the opening quantity, what are the receipts, what are the issues, what is the work in progress, what are the stock that are issued for work in progress, how many wastages has gone in terms of quantity, in terms of percentage, and then they are asking what is the closing inventory on day-to-day basis. It is not an year end. So we have seen a lot of cases during this scrutiny. It was a very tough task for us to give the day-to-day inventory, but they are very, very, we can call it, positively if we want to say, we can call it as a strictly they are asking. If you want that, we are not unable to give, we can call it another way. They are very adamant. Whatever it may be, they are asking this information very clearly. So most of the office has become very conversant to comply with the basic legal requirement like deduction of TDS, TCS, and maybe GST. Almost we are complying with the GSTs nowadays. So almost we can say 60 to 70% perfection we are coming. Probably another 2 to 3 years might be majority, maybe 80-90% efficiency we can come for this GST angle also. But as far as this accounting standard is concerned, I'm not sure how many of us are really giving that much of importance when you are signing our financial statements. We feel like last year it was there. This year also the same there. Okay, let us see. Let's go ahead with it. So one of the example where we saved our skin when we did an audit of an state government enterprises is like we know many of these state government or PSUs are under very big financial stress. They are not even able to pay the PF deducted from their employees' salary. They are not able to remit to the respective PF trust which they have formed. So it has become a very big headache everywhere. Whenever a person from a state government is getting retired, he is not being compensated as retirement benefit. So even yesterday we would have seen in Salem, before the Tamil Nadu State Transport Corporation, there was a big agitation which was carried out by the pensioners of that particular corporation. So the thing is like, when we go for an audit, the people say that the PF trust is our own trust. We have formed the trust. So it is like taking the money from this pocket and putting into this pocket. So we ensure that we pay the pension. The PF trust is unable to pay the pension. However, the company is getting OD limit or something else from the banks, and we are properly remitting the pension. So there is no need to make any qualifications stating that the amount has not been remitted to the PF trust. So this was being accepted, and probably a qualification was not given by our earlier auditors in the report. So AGs, you know pretty well that after our audit, such audit, the AG people will come and do the audit of the state government and any central government organizations. So somehow for a few years that AG department people were also didn't took it very seriously because they know that that problem is in every PSU. But what happened was when we took up the audit, when the first year we made it a very clear point that we have to qualify in our report stating that because it is known to everyone, but so actually we are supposed to qualify it. So if it is not known to everyone, we need not also want to qualify it. But when it is known to everyone, even to the government, then it is our part to qualify it. So when we qualified that particular year, what happened was out of 7-8 corporations around, except the corporation where we did the audit and other 7 corporations, they got caught in the particular thing, like why it has not been qualified. So we are being blamed for it. They said that you qualified it, that's why the other auditors were also caught into that particular point. Like it may be a right point, but the thing is, we are not told something which is not a fact. It is a fact which is supposed to be disclosed. So this is the way that we have to be a little bit cautious when we are going to do an audit. Though it is a known thing, though it is backed up by the government will take care of the payments, but still that thing is not in compliance with the requirement what is being given in a standard. So we are supposed to report it in our report. So similarly, we have given a lot of other reports in our qualified in our reports. For example, like they have not paid the rent properly for their yards where they were taken. In many places they have their own places. Some places they have taken it for rent, but they are unable to even pay the rent. Right? So they are not accounted in the books of accounts on accrual basis. Stating that already there is a lot of loss. If you are going to make it, they didn't have the money to pay the TDS at all. So, but we made it a point it has to be qualified, right? So these are all the small things that we have to keep in mind. So today in my presentation, though there are a lot of accounting standards, majority of the preliminary standards have been covered by Mr. C. Manivel. So because of the time constraint, he has to rush a little bit fast. So I've just taken up only 4 standards. So I'll try to cover it with a maximum period of maybe 1 hour time. So I would also like to have it as an interactive section, like probably my colleagues who are in the Zoom meeting can also just trigger if I'm missing out any point, or if you want to have any thing to be clarified. Either we can put it as a QA session at the end, or if you want to trigger it, you can please kindly trigger the issues there. So the standard 4 standard which I'm plan to just discuss in this forum is like one is construction contract. Another one is earnings per share. This is the area where I'm going to discuss a little bit of more cases. And accounting for taxes on income, we call it a deferred taxation, and then intangible assets. Friends, as I said, it is not only me who is going to put the paper here. We are all conversant, and we are all would have just seen maybe certain standards might have not been applying to some of the clients. Might be all the standards may apply to some of the clients. So I want to make it together. So if anything I am missing out, kindly please trigger me. So you can also add value to this presentation, right? So the deficiencies standard-wise, the areas, wherever Mr. Manivel has presented, he has just given that where those large areas that as a professional we have left out. So I'm not repeating it the same thing here, but what I observed by seeing that deficiency observed by FRRB overall. So majority in disclosure part, that means that we have done the work properly, but we have not disclosed it properly. Either we have not disclosed it, or whatever disclosure we have given is not sufficient for the users of financial statement. So, what are the users of financial statement? The person who is going to use the financial statement, maybe the investor, the shareholders, the members, government. So anybody it may be. So whoever is interested in the particular company, those persons are called as users of financial statement. So majority of the part is like, even though certain things has done properly, but if it is not being disclosed properly, then that is an issue. And something has went wrong. If that is not being disclosed, that is also a problem. Something has went wrong that has been disclosed, but not disclosed in the proper place is also a problem, right? So these are things that we have to keep in mind. Then recognition part, as I said earlier, wherever it is comfortable for the organization, they take on a mercantile system, maybe an accrual system. Wherever it is comfortable for them to take it in the cash basis, they take it on the cash basis. So we have to judicially see which type of accounting they are following. And if you see in banking, we give a disclaimer and of it qualification or a disclaimer in an audit report stating that in certain areas, these things have not been covered in our audit. It has been taken care of by the head office. On certain things, they say it is done on a cash basis. So the reason for why it has been done on a cash basis, that is also being given in the face of the audit report. So this type of recognition, whether if anything has to be declared or reported on an accrual basis, if the management has done on a cash basis, before accepting it as a professional, you have to see why that decision has been taken by the management. If you are convinced with it, yes, you can go ahead. If you are not convinced with it, then you are supposed to qualify it in the face of your audit report, right? And sometimes the interpretation plays a very important role. So we come across a lot of issues in income tax or GST, how to interpret a particular thing. For example, the latest one is from July 18th. New thing has come in GST, reverse charge GST has to be paid on residential building taken for rent by a registered person. So one of the query I also put in the group, but I also just put it in the forum. Like, there's a registered person who is having a rental income that is the main source of income. He is it's a landlord, not a landlord getting a rental income and having the total rental income for a year is less than 20 lakhs. So there is no need for him to register under GST. I have taken an office in that building. I am a registered person. My query is whether as a registered person, should I pay RCM on this rent what I pay to that landlord? Again, it's a very interesting point, but the thing what is given in that GST notification is wherever the residential building is taken for commercial purpose and that commercial entity is a registered entity, then they are supposed to deduct the GST on the reverse charge mechanism. So there was split view. Some of them said that the objective of bringing this notification is to bring all the rental income under GST ambit. So if you are going to take it as it is a residential building alone, then this commercial building will go out of the purview of the GST officials. So that is not the thing. That is not our headache. The government has to think over it. So, but what is the interpretation that I have to take? I have to take which is comfortable to me, which is within the ambit of law. Similarly, if you go ahead with an accounting standard, certain standards that interpretations will come and we have to take a call. For example, in case of AS10 property, plant and equipment, we know how to arrive at the cost of an asset. So whatever I spend to bring the assets for is intended use. You see the purchase value, the freight charges paid, the taxes paid, whatever that I am going to pay to bring the assets for its intended use. You see here the AS10 is very carefully coined. It says whatever is spent to bring the assets for intended use. That does not talk about put into use. As if you see in Income Tax Act, they say it is put into use. Right? So this difference we should be able to classify or understand. So when the AS10 says that whatever you spend to bring the assets to bring it for intended use should be capitalized. We are doing it. And it says any subsequent expenditure which is going to increase the efficiency of the asset should be capitalized. If it is not going to increase the efficiency of the asset, it has to be taken as an item of P&L item. The question comes, what is this efficiency? This is where we have to put our mind. So I just put a practical example. I have taken a building for a longer lease, less than 20-25 years of lease I have taken for my showroom. So it is a fully furnished building I have taken. After 5 years, I am removing all the furnishings, whatever is available in the building. And I'm removing all the flooring materials and I'm putting everything new. the question is, so let us say in terms of value, I'm doing a business of say 25 crores, I'm doing a business, but whatever that I spent for this purpose, let's say it comes around 50 lakhs. I'm talking about 50 lakhs, the furnishing and removing the tiles and laying new tiles. The question is, should this 50 lakhs should be capitalized or it should be taken as a part of my repairs and maintenance under P&L account? So the thing, what AS10 says is, if the subsequent expense is going to increase the efficiency, you capitalize it. If it's not going to increase the efficiency, don't capitalize it. So now how this changing of my furniture or changing of the floor tiles is going to increase my efficiency? What is the efficiency here? Whether it is going to increase the life of the building, if it's 30 years, it's going to be the same 30 years. How this flooring or furnishing is going to increase the life of the asset? So the efficiency has gone there. So then next question, whether should I take it to my P&L account as an R&M? So it is very confusing, no? So I can interpret it in either way. Suppose if I want to take it as an R&M, I will say this stand. So this is not going to increase the efficiency, that is not going to increase the life of the asset, of the building. So I'll take it as a part of my R&M. If I see in the other way, it is a business concern. By furnishing my showroom, I can attract new customers and it is going to increase my sales. Efficiency is increasing there. Why should I take it as a part of my asset? Is them to mute? Somebody is talking there. Mute pannunga yaar pesanga. So this accounting standards also. So what is the call I am going to take? It all is professional judgment. Right? So what are example I just shared with you as a live example which we faced in one of our client and we had taken a call and so far it has been accepted. Nobody has taken a right? For the same client on 1 year we take it as a part of R&M. We had a justification for it. Maybe after 3-4 years, similar type of expense, we take it as a part of capitalization. So for both the things, we have a clear-cut justification why we are taking as part of R&M or why we are taking as a part of capital asset. So this type of interpretation will also play a role if our interpretation or if you are taking call without doing a proper interpretation, or if our interpretation is going wrong, or if you're not able to justify our interpretation, then definitely we'll be taken for a task, right? So these are the things commonly that's being observed by FRRB. So I'll just start with construction contract. The key takeaway that you have to keep in mind in this standard is this standard talks about how a revenue should be recognized in terms of a construction contract. So we have a standard called AS9, how to recognize revenue for a normal items. Like if we make a sale, if we make a service, how to recognize the income, they have given for different type of sale, risk control, everything that given in AS9. The specific standard has been given for construction industry alone, how to recognize the income. So normally just the sum up of this entire standard is the income should be recognized based on percentage of completion method. That is what they say. The next question comes, how to arrive at the percentage of completion. So the formula is what is being suggested in the standard is, I just given the screen, like it should be the cost today, plus whatever date I am going to analyze, what is the profit or loss. So they are very clearly coined cost. They not say cost as on balance sheet 31/3. They don't use the word balance sheet. They have never used the word cost as on 31/3. Something they not mentioned. They have said cost today. Cost, what it means, on which date I am going to do the calculation, have to take the cost up to that date of calculation. Let us say I want to do a financial review for 31st December. The cost date is going to be as on 31/12/2022. And that cost date should be divided by the total project cost. But here they are not using the word project cost. They call it as, again, cost date plus expected future cost. Why they are using that word expected future cost means in construction industry, always there will be an ups and downs in the value of commodities that are being used. We call it an escalation. That's why they are not use the word specifically as a project. They use cost to date plus expected future cost. So if at all you are foreseeing that if there is going to be some increase or decrease in the value, that has to also be kept in mind, taking down the denominator. So it is multiplied by 100 to get the percentage of completion, right? So this is how it is being suggested in AS7. So what are the points we have to remember if you are going to handle a construction industry? You know, now the real estate, again, it has come up. It was very good earlier. Now it was a little bit slowing down. Probably some 2-3 years back, again it started coming up very well, and now many people have started coming for real estate estate business, and you know pretty well now we are supposed to follow RERA also, right? So I think you know what is about RERA, right? Let us Real Estate Regulation Authority is there, so we have to comply with those suggestions or guidelines given by RERA also. So in this scenario, it has to be, we have to keep in mind that whenever a financial statement is going to be presented in terms of declaring the profit or loss for an real estate business, we have to keep in mind this AS7. So this AS7 is applicable only for the contractor and not for the contractee. The person who is going to execute the contract is called as a contractor. This standard will apply only to those persons, and this is not applied to the clients of that particular contract, which is who are called as a contractee, right? And there are different types of contract: fixed, cost plus, and mixed contract. In mixed contract, where some part may be on cost and some part may be a cost plus, right? Okay. Then we should be able to correctly arrive at what is the contract revenue. We should be able to arrive at what is the contract cost. And the most important is the determination of stage of completion, because if there is going to be a change, difference in the stage of completion, it is going to change the entire financial result itself. So probably as a professionals, we are a commerce accounting profession. How do we know technically? We can have to take the support of the architect who are involved in that particular contract. We have to get a certificate from them. Based on it, we have to do our workings. So the next thing is like, is it better? We have a auditing standard where we can rely on the report of the other professionals. So can I take whatever that report is given by the engineer and architect? You cannot do it. You have to vet it whether, because it is going to be a series of certificates we are going to get from a chartered engineer or an architect for the project. So we cannot just like take a certificate from them. We cannot go out with the calculation. You have to vet it, and you have to see, and you have to do a verification also. So you should have a base idea about construction industry. So based on if you are satisfied, you can accept the certificate given by the engineer or an architect. Both of them give a certificate. Based on it, we can go ahead with the calculation of percentage of completion, right? And they are very specifically guiding in the accounting that any future cost, any cost incurred for the future activity should not be included as a part of your cost to date, which we saw on the earlier slide, the numerator. What it means, the future activity. That means, for example, today I feel like the cost of the cement is going to go up. That is why I'm on 26th March. Let us say 26th March, 31st March is going to be the year end. I feel like April, the cost of the cement is going to go up. I am in requirement of say 1,000 bags of cement in the month of April, and maybe 500 bags of cement in the month of May. So now what I do, I bulkily purchase around 1,500 or 2,000 bags of cement and keep it in my godown. I paid the money also before 31st March for it. Can I take that cost of the 2,000 bags of cement, what I purchased before 31st March, as a part of cost? This 2,000 bags were purchased for the purpose of future activity, that is to be used in April and May. You have to take it as an inventory. That should not be taken as a part of a cost date. I think that is the case. Where should I place that money paid for that purchase of 2,000 bags of cement in my formula? Because numerator cost to date, you say that you should not include the future activity cost. I cannot take it there. Denominator again it starts as cost to date. I cannot take it there. And where I can take it. That is why they use the future expected cost. Because this I'm going to consume in the next year. It's going to be consumed in the future year. So that will form part of this area. So this very clearly says if any expense as a part of your cost. And the most important thing is, whatever that value you are going to say, it should be measurable. The base thing in accounting is you can say I am purchased, I am gifted, everything can be that. Unless you cannot measure it, you cannot account it. So let us say my father has gifted, I say my father has gifted me something. You understand? What is the value to it? Unless I am not able to measure the value, I cannot legally put it in the books of accounts. I can put like maybe like bank account to capital account or gift received without putting some value. It doesn't convey any meaningful message there. If bank account, what is the value? It is 1 rupee, 1 lakh rupee, 1 crore rupee. That should be some value. Without having a value, I cannot put it in something called as bank to gift receive or bank to capital. I cannot put it. So the basic thing is whatever the transaction that is happening, that transaction should be measurable. Similarly, in case of A7, in case of a construction contract, that values, let it be a cost or revenue, it should be measurable. That is very, very important. Sometimes it will happen like the outcome of the contract cannot be estimated clearly. For example, I am taking, we are all very clear for a small project, maybe construction a house, a single house or a small culvert. It can be completed maybe 3 months or 6 months. Let's take a project like we have a lot of bridges as come across in Salem. You know, they took some 5 or 6 years to complete those construction. If I am being a contractor, I've taken this contract, which I'm going to execute it for more than 2 or 3 years. Sometimes a situation may arise in such a way that the outcome of the contract may not be estimated clearly by me. Maybe various reasons may be that, maybe a change of government. The new government would have kept the thing on hold. Before that, I would have invested a lot of money there. I would have not got any return from it. The government would have put some thing like some clauses, would have stopped the further construction or releasing for further payments. So something might be there. In such scenario, what should I do? How should I recognize my profit or loss? The standard very clearly states that if there is any uncertainty in the outcome of the contract, you don't recognize the revenue. The revenue can be recognized only to the extent of cost what you have incurred. That means there will be no profit, there will be no loss. Right? So this point has to be very, very clearly kept in mind, because again, in practical scenario, in contracts, many of us, if there is an inconclusive or if there's a problem in the contract, immediately what they do is they want to claim the entire expenses as a loss so that they do not want to pay the tax. But if there's an uncertainty, to the extent of whatever you have spent, to that extent only you can claim it as in your as an actual financial income. That means there will be no profit and no loss. You cannot claim any excess expenditure. Right? Okay. So when a revenue can be recognized in case of a real estate transaction, right? So real estate transaction guidance note is being specifically given by our institute ICA, and it is forming part of AS9. We have a separate standard for AS7 where construction contract. This standard talks about how to declare the revenue based on stage of completion. But we have to see both together. In AS9, guidance note is given as a part of AS9 where they say when you can start recognizing the income in case of a real estate transaction. So there so many conditions are given, but 4 main conditions that are given to begin the recognition. Those are given in the screen. First one is all critical licenses which are required to commence the project should have been obtained by the contractor. What are the critical that may vary from project to project? For example, some may require a pollution clearance, some may require a soil testing. Apart from regular building approval, all those things may be required. Suppose if there need to be a slum clearance, maybe from a slum department, a clearance certificate might be required, right? So maybe and clearance from the EB department to transformer there. So all these things may be. So what are critical approval that is required to execute the projects? Those critical approvals has to be. There may be some non-critical approvals also. Those things are not important. All critical approvals should have been obtained. So there is a one condition. First condition I have to keep in mind. The second one is the execution of the project should have been completed at least 25%. So what I'm projecting, this is going to be my total contract cost and this is going to be total contract revenue. Out of it, at least 25% should have been completed. So that is the second condition. Then third condition, at least 25% of the saleable area should have been booked. They say that means almost they should have identified the customers. That is why I'm having some 100 units of building. So I should have identified at least 25% should have been booked. They don't say you should have collected 25% amount. They say 25% of the unit should have been booked there. And out of the 25%, at least 10% of the amount should have been collected by you from the customers. If all these 4 conditions are satisfied, then you can start going in for recognizing the income based on percentage of completion. Suppose if one of the conditions is not being satisfied, then you cannot start recognizing the income. You have to postpone the recognition. Then what should I do? The amount spent that has been kept as an inventory. It cannot be taken as a part of a sale component in your financial statement, right? So some of the cases that is being identified and referred to FRRBS. So one is like, this is what they have identified. Job work revenues accounted on the basis of running bills raised and approved by the clients. So revenue expenditure accounted on accrual based as and when it is incurred. So this is what they identify. What is this running bills raised? So I can raise any n number of bills on my customer. Whether the bill is an advance bill or a sale bill, that is going to be the question here. If it is going to be a sale bill, it has to be based on the percentage of completion. But in the current scenario of GST, excuse me. Screen. So the observation here by FRRB is it should be based on a stage of completion. It should not be based on running bill. So we should understand what the difference between a running bill. Normally we feel like once I have completed the what we call it as in cost we call it as work certified and work uncertified. I have completed a work in a contract. If my client has agreed for it, then I can start billing for it. If he has not given his concurrence, I have to wait till he uses this concurrence. So we call it as a work certified and work uncertified. So how to classify this work certificate and work uncertified? Normally, work uncertified will be taken as a part of his work in progress. Work certificate will be taken as a part of your data. This is how we have an idea of how to handle about it. So this running bill concept should not be taken as a criteria for recognizing the income. It should be based on the percentage of completion, right? So FRB has identified that in an annual report of a company, they have included the inventory, but they have not included certain other items. What are other disclosures required to be made? So generally we think like inventory or this is one thing that comes in our mind. Like what are the unused, unconsumed materials are there in the site, the contract site should be shown as a part of the inventory. So we check on all those things. Like what are the other things that are expected? So these things are very, very important. What is it? The aggregate amount of cost incurred and recognized profit. Less recognized cost up to the reporting date. So let us assume I am in the third year of a construction business. First year gone, second year gone. I am in the third year. Let us assume it is going to complete in the fourth year. So business is going properly. Year one, I have calculated my stage of completion, recognized my revenue, recognized my expenditure, and recognized my profit or loss. I've done the same thing for year 2 also. And I'm in the year 3, the stage of completion, what I'm going to calculate is going to be cumulative one for starting from year 1 to year 3. I cannot do it separately for each year. So what are calculation I'm going to do? Because the formula, what I was saying is cost to date divided by cost to date. Cost to date means cost starting from day 1 to date of where I'm going to do the calculation. So cumulative one. So whatever result I'm going to get is also going to be cumulative one. Whatever that based on stage of completion, what is the revenue I'm going to calculate is going to be a cumulative one. Whatever cost I'm going to calculate is going to be a cumulative one. So what they do is, though you aggregate it, but you have to separate what you have declared. You have to eliminate what you have declared in year 1 and year 2. Then you'll get what is the portion risk pertaining for the particular, that is year 3, you will get it. So that only you have to take it as a revenue for that particular year. That only you have to take it as a cost for the particular. The difference is going to be profit or loss for the third year. So the aggregate amount of cost incurred. So what they have done is they have given the what is the profit or loss for the particular year, but they are not declared, they are not disclosed what is the aggregate of things that has happened. That has to be given a separate note in your financials. That is what they have. So you are supposed to recognize your profit or loss for the current year. However, you are supposed to give the aggregate value also in your financials, which is not being done. So recognize profit and loss is properly recognized. No issues at all. We have signed a correct balance sheet. We have signed correct financial. But still, if the aggregate is not being disclosed in the financials and notes of accounts, then you are supposed to qualify it, or we should ask the client to disclose that part also, right? Then the amount of advance received. So we don't show it separately. We show it as a part of normally the advance. I just explained to you how the advance has to be calculated based on the running bill. We just discussed in the previous based on the previous issue identified by the FRRB. So whenever there is when you are going to recognize the sale, if there is an advance component that has to be segregated, that has to be shown separately in your financial statement as advance receipts from the customers. But many of them, they are shown it in the financial, but that is not being explicitly shown as an advance receipt. Either they show it as a part of sundry creditors, they show it as a part of trade payable. So what is sundry creditors, trade payable? That means that we have purchased something and we are owing to them something. That is what that meaning of sundry creditors or trade payable are meaning. That is what we understand. But if you are going to show this advance receipt from the customers as a part of the sundry creditor or trade payable, then you are not disclosing it properly. As some of them, what they do is they deduct from the debtors. They show the net value in the sundry debtors. They have certain debtors. They deduct the advance receipt from the overall amount. They show the net figure as a debtors. That is also wrong. So whatever the advance receipt has to be shown separately. Then the amount of retention. What is the retention? If the customer is going to pay me some amount, and if he's going to retain some amount, is that mean they call as a retention here? If suppose normally that does not happen in a real estate industry. I am doing the construction. I have some customers. I'm constructing some buildings. Some 10 customers are willing to pay from purchase from me. They cannot retain any amount when they're making the payment. If they're going to take that stand, I'm not going to sell them. But if you take a very big commercial unit, like for example, the bridges what is being constructed in Salem. Do you think that government, that is that their government has fixed 100 crores for constructing the bridges? Do you think the government would have released the entire 100 crores to the contractor? Definitely they will not do. Because if something happens, some small repairs happens to that in the construction, the contractor has to set right it. So the government will either retain some amount, what they are supposed to pay, or they'll get a bank guarantee. So this is one part. So when there's a retention from the payee side, the quantum of retention has to be reported there. It may be happen the other way also. I'm a contractor. I'm engaged some subcontractors. So same thing I'm going to do. When I'm going to pay to the subcontractor, I'm going to retain some amount. That is also a retention amount. So it will come in the both ways. So if there are any retention amount, that has to be exclusively reported in the, or I'm going to say separately shown in your financials, right? Then I'll proceed to the next standard, AS20, earnings per share. Probably you have a lot of cases here. The key takeaways are, the thing is like, we have to keep in mind the weighted average number of shares. This is being recommended in AS20, and diluted earnings per share, then anti-dilutive concept, the restatement of EPS and diluted EPS, calculation of incremental PAT, profit after tax, and incremental EPS, and order of consideration presentation, how this has to be reported in case of a dilutive nature, how it has to be presented in the financial statement. So these are the things that is being recommended in this AS20. So normally while calculating the EPS, What we do is we take the profit after tax, we divide it by the number of shares that is outstanding as on the balance sheet date. Now this has been the practice for so long, but after the introduction of this AS 20, this standard has very clearly mentioned that when you are going to calculate your EPS, you have to consider only weighted average number of shares and not your share number of shares outstanding as on the balance sheet date. What is the difference between this weighted average number of shares and what is the number of shares outstanding as on the balance sheet? This we have to be very clear. If we don't have a clarity between these two, normally we think that the number of shares what is outstanding as on the balance sheet date is equivalent to the weighted average number of shares, but both are not the same. Then what is this weighted average number of shares? Let us assume it's a running company. I have opening number of shares, 1 lakh number of shares I have in the beginning of the year. At the end of the year, 1 lakh shares, my weighted number and my outstanding both are going to be same, no issues at all. During the course of the year, within the year, I have issued some new shares. Let us say I have issued and some say, let's say 25,000 new shares on 1st October. My accounting, let us take it from April to March. So April 1, I had 1 lakh number of shares. On 1st October, I'm issuing another 25,000 shares. So the end of the year, I'm having 1,25,000 shares. So does this 125 shares outstanding as on the balance sheet date is equal to the weighted average number of shares? That is not so. The reason being the 1 lakh shares have been all together in the business for the entire 1 year, whereas the 25,000 shares has come only in between the year and they have been in the business only for 25, that is 6 months. So I can give only a proportionate weightage to them. That means they have been half of the years, I'll give only 50% weightage. That means the 25,000 number of shares will be taken as equivalent to 12,500. This is one way of calculating weighted. Similarly, there are a lot of weighted average methods are based on the face value of the shares. Maybe some face value of the shares may be 10 rupees. Some face value of the shares may be 7 rupees. Some face value of the shares may be 50 rupees. So for this also we are supposed to do the weighted average. So that is what they are very specific that while calculating the EPS or diluted EPS, you are supposed to take only weighted average numbers and not the regular numbers, right? So in one of the cases, they are given that there is no diluted earnings per share in the company, so it is not applicable to them. That means there is no movement. Opening whatever number of shares I had, what is the closing number of shares, both are same. But we should understand what is the dilutive nature. The dilutive nature doesn't come opening number of shares and closing number of shares. It doesn't come due to fresh issue of shares. This comes because of some other nature. What is some other nature? If some shares are issued at free of cost. For example, I'm doing a rights issue. 15 rupees share, I'm issuing it for 12 rupees. That means the difference 3 rupees is nothing but a bonus element included, embedded in that issue. I'm issuing some share options at a reduced price. The market value is 75 rupees. I'm issuing it for say 50 rupees or 60 rupees. Again, the difference, there's a difference. There is a bonus element that is included. So for that bonus limit, what is the corresponding number of shares that the company is going to issue without any cost? So these things are to be done. Apart from it, I have a debentures which are of a convertible nature. As on this year, it is a debenture, but it's a convertible debenture, which I'm going to convert after 3 years. So what this standard asks is, I understand you are going to convert after 3 years. Assume if it would have been converted this year, that is deeming provision, like what we say in deeming provision in income tax, they call it deemed. They say if that has been done during the current year, how your EPS would have moved. You calculate the normal base EPS, you calculate it based on the weighted average number of shares. Then if this debenture is being converted to shares during this year itself, what will be the impact in your financials? If I am converting the debenture into shares, the shares mean they call it as equity, not preference shares, equity shares, then in future, I need not want to pay the debenture interest. So to that extent, my expense is being saved. If expense is saved, automatically my profit is going to go up. So can I take the revised profit for EPS calculation? No. If your income is going to go up, correspondingly, there is going to be an increase in tax. So find out the tax and reduce it. So find out net incremental value. So that net incremental profit, whatever incremental profit you have, divided by the number of incremental share by converting the debenture. I have 1,000 debentures. If I'm going to give 2 shares for every 1 debenture, it is going to be 2,000 number of shares. So what is going to be incremental EPS? If I'm having some preference shares, so I'm going to convert it as a equity share in the future. Do a similar exercise. Earlier we had CDT, corporate dividend tax. Now we don't have a corporate dividend tax. So now we can forget about CDT. So the dividend what I'm supposed to pay to the shareholders, it will be equity shareholders or preference shareholders. it is a post-tax profit. So if I'm going to convert this preference shareholders into an equity shareholders, I need not want to pay preference dividend. So my profit after tax is going to go up. Not my profit before tax is not going to go up. My profit after tax is going to go up. So will there be any tax impact? There will not be any tax impact. The company's hand. Right? So these things has to be kept in mind. This is kept in mind, and to take a call whether that earnings per share, whether by converting these items from debenture to equity shares or from preference share to equity share, from share option to equity share, because of this conversion, whether the earnings per share is going to come down or go up. If it is going to come down, my normal EPS based on weighted average method is, let us say I've got an EPS of 8 rupees. By converting this debenture or by converting the preference share, if my EPS is going to come for 7 rupees 50 paise, that means because of this conversion, your EPS is going to come down. So this instrument is a dilutive nature. This is going to dilute your EPS. Instead, if it is going to increase my EPS from 8, it is going to go for 9 rupees, 8 rupees 75 paise. It is not dilutive, it is anti-dilutive. It's always better to convert this one as early as possible so that you will get a better EPS for your shareholders. So this is a basic concept that is being explained in this standard. If that is the case, then this company has given that dilutive is not applicable. What FRB says is, you cannot give it as an applicable. You have to say whether it is there or not there. If it is not there, give it as a nil. Don't call it as not applicable. This is what they say, right? Though it is not a serious issue, but this is the observation that is being given by the FRB. They refer certain paragraph from the particular standard, which I am not repeating it because I have just shared the content with you. So ultimate thing is that you are supposed to show it as nil instead of showing it as a not applicable, right? So next issue, what they have identified here, they have shown only the earnings per share. So what they actually expect is, they expect you to mention whether it is a basic EPS or diluted EPS. That means we have shown it as EPS in the financials. We have read what is the profit after tax. We have read what is the number of shares based on weighted number of average number of shares. PAT divided by weighted number of shares. We are given this is the EPS. But on the face of the financial statement, we have not mentioned whether it is a basic EPS or it is a diluted EPS. So the readers cannot understand what you are actually conveying there. So they wanted very specifically that you have to mention whether it is a basic or diluted, right? So while calculating the EPS, we arrive at only the value of the EPS. But the nominal value of the shares is normally given as a part of the schedule in the financial statement. One question arises whether it should be shown in the particular case. They have not even shown in the notes of accounts. The schedule also they have not shown the nominal value. That is why the case was referred to FRRB, right? So normally now we have got all the templates. We have got, like when there is a revision, when there was a revision in Schedule 3 last year, we got the templates and all the templates properly. We are having all these things. So now we cannot leave it. For following the template, we cannot leave any of these things. But earlier it has happened that they have not mentioned the nominal value. So the thing is, like, they are supposed to show the nominal value as per the particular paragraph given in accounting standard. The question is whether it's enough to show it in notes of accounts, or should it be shown in the profit and loss account, or should it be shown both the same. To be frank, it has to be forming part of your financial statement. So notes of accounts is also forming part of your financial statement. So it is enough if you show it in the notes of accounts, maybe call it in schedules or whatever the name you give it, we can show it. Suppose in addition, if I'm going to show it as a part of a profit and loss account, anything is barred? No, nothing is barred. You can show it as a part of the P&L also. But where it has to be appropriately placed, again, it's a question mark, but generally it's recommended to show in notes of accounts. But what I feel, if there is an expectation, there's no, never mind, we can show it as a part of your P&L also. It is going to be an appropriate, it is going to be below. There's no harm in showing there also, but even if you show it as a part of your notes of account, it is kind of more than enough, right? So in one of the case, they have seen that there is an increase in the number of shares when compared to the opening and closing. Directors' report is also confirmed that there is an issue of fresh shares. While calculating the EPS, the company has considered only the outstanding number of shares which was available as on the balance sheet date. Why this has been particularly put is because I said the weighted average number of shares has to be kept in mind. That was not kept in mind by the particular organization. So they were very specific that they have not complied with this particular standard. So is it going to affect the company? That is something different issue. The ROC is going to come, company law board is going. But as far as members are concerned, if you are going to certify it without seeing this, then we'll be taken into task. And if something goes wrong for an investor who is invested in the company, if he says that based on the EPS what is being given, I have decided and I have invested in the company. The chartered accountant has not properly vetted the figure. So I've been misled by the figure that has been declared in the financials. Mean then we'll be recommended to a disciplinary committee and the action will be taken on us. So that thing has happened in the particular case. The next question is, I have received share application, but I have not issued shares so far. As on the balance sheet date, I have not issued the share. I have just merely received a share application money. Then should the number of shares be increased? If it is a convertible debenture, convertible preference shares, okay, I know pretty well. But what about share application money received? Pardon?
Shares are allotted, then we should take. Application is received, but if shares are allotted, allotment is done.
Allotment is done is okay. I received only share application money. Allotment not done as on the balance sheet date. Right, let us see the observation given by FRR. So the A is very particularly says if the share application money is received for any particular statutory purpose, if it is obtained for any statutory purpose, we need not want to consider it. If it is not for a statutory purpose, you have received it, you are about to issue the share. You have not done as on 31st March, but you are going to do it maybe in April or May. You know, there is a time target to issue the share. We cannot keep it quite long, right? So you are about to issue the share, but that process has not been completed as on 31/3. What you do for debentures, what you do for convertible debentures, what you do for convertible preference shares, which you are going to convert only after 3 years. But you are utilizing a deeming provision. Similarly, for share application money also, if there is no uncertainty in allotting the shares, the deeming provision should come here, and you are supposed to calculate the number of shares taking into consideration this share application money also. Right? In the annual report of a company, the company has incurred a loss, so they have declared their EPS and diluted EPS as nil. Is it right? Whether should EPS or diluted EPS should be calculated only when there is a profit. If there is a loss, normally we say negative doesn't have a value at all. That is one consideration I have. So negative is nothing. That means it's actually zero. So why should I report a negative? Instead, I am going to call it as a zero. So this is what a company has taken a stand. They have declared it as a zero. Then they are having a loss. So is it correct or not? Zero is nothing. Minus is also nothing. So it is also equivalent to zero. That's a normal thing that we have. So we have to go ahead and see what is that being prescribed in the standard. It particularly says that even if there is any negative, that has to be reported. So our common understanding might be anything. Sir, negative is also nothing, zero is also nothing. But the standard very particularly says that if anything is negative, that also should be negative. The user should know what is the negativity that it has. Maybe minus face value of 10 rupees minus 1 will not have much impact. If it is minus 125, whereas my face value is only 10, might be whether you have to think it over whether the going concern concept of the company is there or not. This is a very big litigation we have when you do government audits. Almost all state government organizations are running in a loss, big loss. So the basic assumption of going concern is being defeated there, but still we are certifying it as a going concern. So how to take a stand if suppose tomorrow FRRB or someone is asking us, they have a cap net worth of say 1,000 crores, whereas they have a loss, net worth here I mean excluding a loss, taking there only their capital nature, excluding, because our shareholders fund includes your loss also. Here I'm eliminating the loss, taking the shareholder fund without the loss. This, let us say, there's 100 crores, 1,000 crores, whereas this component of like loss has gone for, let us say, 1 lakh crores. How can you say it is the company will be in the long run will be going as a going concern? But still we certify it as a going concern. Then how can we save our skin? We cannot say it's a government backed up company, sir. So something goes wrong, government will come to the picture. Anytime government may also can take their hands away. You know, everything is being privatized in the days. So what is being taken care there is we see what is that asset worth that company is having. Suppose if they have an asset worth of more than this 1 lakh loss, what I'm stating there, if they have that much value of asset, then we can take a stand. This is only my suggestion. Maybe I may be right, I may be wrong. Right? So suggestion is, yes, if at all something happens, this assets can be liquidated and this loss can be wiped off. This is one stand. So normally if you take any chartered accountant who is signing a state government audits as a going concern, this would be the stand they are taking to certify it as a going concern, right? So even a negative part has to be reported. You cannot call it as a nil. So the earnings per share and diluted earnings per share should be, negative figure should be disclosed in your financials. The next thing is extraordinary items. So the new schedule 3, that new template, they are very clearly given where to put the extraordinary items, how to take it for various calculations. Everything is, we have gone through the new template, could have very well identify it. So in the particular case, what happened is while calculating the earnings per share and diluted earnings per share, the management has taken the extraordinary nature of items, or it may be an income or expenditure. They say it is extraordinary item. We are not sure whether it is an income or expenditure, but they have considered the extraordinary item also by calculating the EPS and diluted EPS. The question is whether the calculation done by the management is right, and it is certified by one of our profession also as right, and they have agreed with the working what is done by the management. The question is whether the extraordinary items can be taken as a part of calculation of doing this EPS and diluted EPS. The standard very clearly says that the particular paragraph 48 says that the extraordinary item should be excluded while calculating the EPS. Let it be a general EPS, or let it be a basic EPS, let it be a diluted EPS. Any extraordinary nature of item that is included in your financials should not be considered for the purpose of calculating the EPS. So that particular company has erred by including this one, and that particular chartered accountant has also not noticed it. That's why they are taking it to task, because let it be an income, let it be an expense. For an extraordinary income, the EPS would have been more. Again, that would have misled the users of financial statement. Another way, it is an extraordinary item, is an expenses, the loss would have been more, or the profit would have come down. Again, the EPS would have, there is a change in EPS, the decision taken by the users would have been different, right? So this is the reason why it is being particularly given. So whenever an EPS is being calculated, the extraordinary item should be excluded, right? So a question normally arises. Normally, in fact, myself, Mr. Manivel, have discussed in the morning. So how to declare this prior pay items? We are identifying certain prior pay item, maybe because of GST that the client has not put in there is not filed GST R1, so it has not come to my 2B. So, but I have claimed it. Now I have to reverse it. Should I show it as a prior pay item? Should I show it as a part of current year item? What should I do? So this standard, which is AS4, which particularly talks of prior pay and extraordinary, says that anything that is coming into your knowledge during the current year because of some errors or omission in any previous year, that they will call it as immediate preceding year, any previous year. If you are identifying it during the current year, then you have to show it as a prior pay item. So on the face of it, if something is omitted, the error or omission may be due to my mistake or due to some other mistake, which I'm coming across. In this case, my supplier has not done it, but I am suffering because of it. So should it be shown as a part of a prior pay item? On the face, if you see the standard, yes, it has to be shown as a prior pay item. But if you go deep into the standard also says, keep in mind the materiality concept also. If the figures are not so material, if non-disclosing it as a prior pay or extra item is not going to affect the decision-making capacity of the users, then there is no need to show it as a prior period item. So it's a very best judgment. The judgment has to be taken by the management and that has to be accepted by the professionals who is vetting the document. Very, very open thing, right? But this is the challenge that we have in the profession, right? So if it is going to be material, you have to show it as a prior period. Just for the sake, for a non-material item, you are going to show it as a prior period item. Okay, accounting, yes, you will be taking a very good, you have done a good job. But if you go to income tax, what they say is if it is a prior period item, go take back to that particular year, revise your assessment, do the reverse calculation. What are the tax that you are supposed to pay there? What is the tax that you are going to increase or decrease here? You have to give a very big reconciliation. All these things you are supposed to give it to the tax department. So if it is a material thing, you don't have a choice. You have to do it. If it's not a material thing, you can take a call like you can take it as a part of a regular item. Similarly, if this extraordinary item is not going to have a very big impact in calculating the CPS, maybe 0.1 rupees. For example, normally that EPS is being declared every year, somewhere an average of 50 to 60 rupees is being declared. I have taken an extra item which has either increased my EPS by 1 rupee or decreased my EPS 1 rupee because of this extraordinary item. It is not going to have a very big impact in your calculation. Whereas by taking this extraordinary item, the 50 rupees EPS in the previous year has come down to 45 or 40. Whether it will have an impact, yes, definitely will have an impact. How you say 1 rupee will not make an impact, how you say 5 rupees will not make an impact is again a judgment, a call. If you want to argue this 1 rupee is going to have an impact, you have to say other thing. If it's not going to have an impact, you have to see that thing, right? So it all depends on what the impact it is going to have, right? So generally, what is being recommended at the standard is while calculating the EPS, the extraordinary items should be excluded in calculation, right? This is very, very important. You have to exclude it. So basically, any extraordinary item should be excluded. There is no choice at all. There's no choice at all. If you feel that some extra item, no issues, that has come only the current year. So again, they talk about only extraordinary item. They don't talk about prior period item. Only prior period item, you'll have a problem. Anyway, yes, sir.
So speculative gain on stock is a part of extraordinary item or it's a normal income?
Speculative, if you are doing a speculative.
Suppose my closing stock is increasing. On date, I have purchased any item for 50. All of a sudden, if it is increasing to 120, will it be considered as extraordinary or?
Sir, if you see AS2, if the increase or decrease in the value of this of a temporary nature, there is no need to alter your values. If you go and see AS2, you have purchased and you are properly valued either FIFO method or whatever, you have kept it as on 31st March, you have kept it as 50 rupees per kg or whatever the unit, 50 rupees. But due to some market spike, it has gone to 120 rupees. The next question is, it comes cost or whichever is, so automatically cost is going to be 50. We'll take the other way. It's 50, it has come to 20 rupees. Should I reduce my cost from 50 to 20? So if it is on the face of AS2, if you see cost or NRV, the NRV is 20, my cost is 50, I'm supposed to reduce it to 20. But again, they don't want you to take an ad hoc call because you have sufficient time to file your returns, to finalize your books of accounts. If this is of a temporary nature and subsequently your cost will come back to 50 or it is going to go back to more than 50, you don't disturb. So I'm going to complete my financial maybe April 20th if it is a banking, or maybe 30th of April if it is a listed company where they want to do it quite quickly, finalize the thing. Or normally we have July or maybe September. Before this time, this cost is again coming up. And if you are able to demonstrate it, though it has gone to from 50 to 20, later on it has raised up to 50 or more than 50, you can retain the same 50 rupees in your bank. Right? Okay. Right? We'll go to the next one, accounting for taxes on income. So the main thing that we have to keep in mind is the timing difference and permanent. What is the difference between a timing and the permanent difference? And what is current tax, what is deferred tax and tax expenses? I'm sure we are all more comfortable with those things because it has become norms of the day. We have started doing it for not only for companies, for non-companies also when they take two different stands for the purpose of income tax and for the purpose of books. Normally, many people will take the depreciation. For income tax purpose, we take the income tax depreciation. For book purpose, we take a little bit of lesser value because they want better net worth. They want to go for a finance. They take it as a part of an accounting policy. In those scenarios also, the deferred taxes come into the picture. So I'll not go deep into this deferred taxation. So what are the issues that has been identified is?
Calculating net worth, whether it is detail or
in my opinion, net worth is only what is pertaining only to the owners of the business. But as a company, shareholders, non-company owners of the business. DTL is a liability which you are supposed to pay to the government in the future day. Today you are not supposed to pay, but future you are supposed. So it is for outsider. Also, government is outsider. That cannot be form part of your net worth.
Right now, it will not be future only.
Let us if you take that stand, I have taken an loan, which I say I paid after 1 year. This year I am not going to pay the loan. So can I take it as a part of my net worth? There are two different stands for certain thing. If your loan, if you no, you take, say if you take a credit task where the creditor has given me 1 year.
It is forming part of one part of the resources.
No, sir, I'll come back to that. This conception is very clearly spelled out in the standard. Many of us we are taking as a part of reserves and surplus. This standard very clearly says it should not form part of your reserves and surplus. Right? So probably if you have seen the new template in Schedule 3, this DTL would have not been formed part of your reserves and surplus. It is not part of your reserves and surplus. It is so reserves and surplus should contain only the amount that is pertaining to the owner, that is shareholders of the company. In case of non-companies, to the owners of the company. Right? So for various other reasons, might be for a bank loan, we do something. So that is not a rule. Okay, that is practice. That is something different, right? So law, because they don't know the subject, sir. They rely on you. Simple. They rely on you. They rely on you. Whatever you give. That is why the more. Yeah, the more emphasis. That is why the more emphasis given for the chartered accountants. The certificate what we make, right? So that is why we have to take a call. If it is a genuine client who will repay the loan, they can take a risk. Risky client, we should not take the risk. That's simple, right? Okay. So the next one, whether it is necessary to show the breakup of DTL and DTA. What is the breakup of DTL, DTA? So we arrive at what is the deferred tax type of deferred tax, making certain calculation as recommended in the AS22. And we give the final figure there. The balance sheet, we give either DTL, we give this as figure, or DTA, this is the figure we give. But how we have arrived at what are the major component? If it is going to be one and only component, but it is going to come only because of depreciation, no issues. We have multiple component, maybe the DTL or DTA arising because of my 43B provisions of income tax, where TDS has not been deducted this year, so this has been disallowed, and I will allowed next year. Where I have not remitted the PF this year, so this is disallowed. I am paying for the next year, is going to allowed. Similarly, we can compound some other items also. So, if multiple components are going to form part of my DTL and DTA, in balance sheet, I'm going to give a single item, either it is going to be DTL or DTA. Is it more than enough for the users of financial? This is the question. But what FRRB is very clearly stating is, this difference, I just said because of depreciation rate or maybe a depreciation method or maybe a difference in because of section 43B. So depreciation rate, we know different rate for Companies Act and different rate for income tax. And as far as method is concerned, normally in income tax, we follow WDV method. But in books, if you want to follow SLM method, yes, you can go ahead with it. So if that is again, because of change in method, there's going to be difference in the depreciation value, right? So that's why these things are going to contribute for this one. So the standard very clearly says if more than one item are going to contribute for the purpose of this DTA DTL, the breakup has to be given in the notes of accounts. It is not sufficient that you have all these working papers with you. Yeah, you have the working papers. You have to give those things in your notes of accounts also. Not workings, the major components. Let us say I am arriving at 1 crore rupees as a DTL because of depreciation this much, because of 43B this much, because of change in method is this much. This breakup, not the entire working. So this sum total of it comes to 1 crore rupees, right? The next case is recognition of deferred tax asset. So we follow conservatism concept. Whenever there is a liability, it has to be accounted immediately, whether you are going to pay it or not. There is something different. But if something comes to your business there is going to be some liability in the future, you have to account in the books of account. That it is reversed as far as asset is concerned. An asset can be accounted only when there is a reasonable certainty that you will receive that resource. Only when you reserve the asset. Otherwise, you should not recognize it. So the question comes whether can I recognize my deferred tax asset, because today I'm paying more tax, which I can get it reimbursed in the future years. So can I recognize it? DTL, it is mandatory. I cannot go out of it. In case of DTA, is it mandatory for me to account it in my books of accounts? Yes, it is mandatory. When it is certain, reasonably certain that there will be future income, will be going to pay more taxes. At that time, you can adjust this deferred tax asset. Yes, you can account it. Suppose if the management is unable to demonstrate that there will be future profit, and this tax can be adjusted against the proof profit. If they are not able to demonstrate it, then the deferred tax asset should not be recognized in the books of accounts. What happened in the cases like they have recognized it as a loss-making company. Another one case is that loss-making company, they had some carry forward losses where the management has just certified that we are sure that there will be profit in the future. We can recover this tax what they are paying now. They're just given the charter account has received a letter from the management. They have certified it, but there is no evidence how this company is, how this business concern is going to earn that profit. They are not justified it in a proper way. They didn't show any evidence. The auditor has not collected any evidence for it. For that, he was penalized, right?
If we are recognizing DTA, isn't it the violence of prudence as per AS? Like it is asking only to book anticipated loss, not the profit.
So you have to see it along with the conservatism concept. Though this AS1 talks about prudence. So basically, we come across some 10, 12 concepts which starts on money measurement entity concept. So one of the concept in this is conservatism concept. That concept very clearly says expected losses should be accounted. Expected income should not be accounted unless otherwise you are certain. So you are taking the call based on that concept. So it is not a violation of prudence, right? So this is losses. So can I take another 10 minutes? So the next question, where the DTL and DTA has to be present in my financials. So whether it should be shown as a part of my loan fund, should be net off with my current asset, or should be shown as a part of my application of fund, as part of my shareholder fund, be shown as a part of separate item under provisions. So this confusion has come for so many people, so not only we, so many professionals, so many chartered accountants, we had this confusion that it should be shown in the financials. So the standard very clearly says if it is a deferred tax liability, it has to be shown after unsecured loan, not a part of a reserves and surplus. If it is a deferred tax asset, it should be shown after investments. The end of the head, investment. This is the area, place where you're supposed to show your DTL or DTA in your financials, right? You cannot show it as a part of your loan funds. It can be shown as a part of your shareholders fund. It cannot be shown as a part of any other item. And it cannot be netted with any other item. So the next question may come. Previously I had DTA, this year I have DTL. Can these two things can be netted? That can be netted now. But I cannot net my DTL with me any other current asset. I cannot net my DTA with any other liability or DTA with any other asset. It has to be shown separately, right? But whereas DTA and DTL can be netted off, right?
Last year DTL, this year DTA.
We can net it off and show it as a individual figure.
When giving 2 years comparative figure for the company, last year I can show you show the figure under the RC, below the RC below. This year, after some investment, can I show you?
So we give a clause there. The figures have been rearranged where you are required.
Yeah.
That means there is a requirement. Last year it was a DTL, it is a DTA, so that has been rearranged. If at all you feel it has to be more transparent, keep it as a part of your notes. It will be more than enough, right? So A is 26, intangible assets. So today go to the cases. So in one of the case, the items shown in the screen like factory license fees, trademarks, seed marketing expenses, public capital issue expenses, preliminary expenses, and paid for pre-commencement of retail stores. All these things has been taken as a part of their deferred revenue expenditure. But one thing what you have to keep in mind is the concept of deferred revenue expenditure removed by institute after the AS 26 has been brought into effect. But still many of us are still showing as a part of a deferred revenue expenditure based on the definition what is given for deferred revenue expenditure. But today we are not supposed to show it as a part of a deferred revenue expenditure in our balance sheet. So if the expenses, if you are able to identify a particular expense is going to be a resource, that means it is going to be an asset. That means this expense is going to generate me any future economic benefits. Then I can do it, take it as a resource. That means I can classify it as an asset and show it as my balance sheet. If a particular expense is not going to fetch me any future economic benefit, then I have to expense it in the year of expenses itself. So we had the concept of preliminary expenses, pre-operative expenses. So in the first year, if I'm going to show everything, there's going to be a huge loss. I'll not be able to raise funds further. So what we do, take it a pre-operative expense, take it a premium expense, write it off over a period of 5 years, take it an accounting policy. So we are doing it. But this standard very clearly says any pre-operative expenses, pre-commencement expenses should not be taken as, they say it is deferred revenue expenditure. Then can I classify it as miscellaneous expenses, miscellaneous assets, sir? Different jargon you are using. Same wine, a new bottle. So the objective behind this is any pre-commencement expenses which does not come under the definition of asset, that is resource, should be expenses in the year itself. That is the cream of that standard. It's spelled out in both AS10 and PPE, property, plant and equipment, as well as AS26, because that is for tangible asset, this is for intangible asset. That's it. So we cannot go and interpret it to our convenience, right? So we have, but still we are doing somewhere, we are following it up. But we have to be very careful. But if at all somebody is going to pick out this case and they are going to ask you the query, we are going to be in trouble, right? Okay. So amortization, if it is an purchased item. So if you satisfy the criteria of asset and if you are taken as an intangible asset in your balance sheet, you can claim the amortization. You have to claim the amortization. You don't have a choice not to claim it, right? So resource I just shared with you. So in the given case, the seed marketing, public capitalization, premium expenses, and then rent paid for pre-commencement of retail stores or factories should be taken as a part of a P&L item, should not be capitalized. As far as this, one minute. As far as the factory license and trademark fees are concerned, those things are for specific period. So that I can operate till the license is alive, is having life. So if I want, I can take it as a part of my intangible asset, right? And I have to amortize over the life of that particular license period, right? The technical know-how which pertains to a particular asset. That is, I have purchased a very big plant and machinery. Now we know all the plant and machinery are, we can operate through some technical technology like computers, like from remote computers, we can use it. We can install some software sitting somewhere through software, they can operate it. If you have seen the WhatsApp some 2-3 days back, the doctor sitting in London, it making a stitches in a banana, like how the operation can be conducted remotely through artificial intelligence. So machinery has been invented to test it. What he has done is he has peeled the banana and then he's stitching through artificial intelligence. He's giving the command to the robotic, which is being, I'm not the place where that was kept. The doctor was sitting in London. That robotic is in some other place, is operating from there. He's very silkily, it is stitching that banana without any damage to the banana. That means tomorrow, as now the KPO has come, when we completed, we had to go abroad to earn there. Then BPO came, then KPO, knowledge process also came. Now we can sit here and give consult to our clients there. Now, if you want to undergo any critical surgery, we have to go for London, UK, US, somewhere you are supposed to go. But once if this has become successful, a person in Salem can get his surgery done in a top hospital. A doctor specialist may be sitting maybe in London, maybe in US, he can conduct the operation here. Like what we call as knowledge process outsourcing. This artificial, this WhatsApp is rounding around for the past two to 3 days, right? The technology has gone that much impact. Here, the technology has been taken for a plant and machinery, and the technology the value of the technology know-how is also being depreciated along with that particular asset. The question is it right or wrong? So before taking call that I will take that know-how as a part, technical know-how as a part of that particular machinery, I will take it, I will depreciate along with that particular machinery. Certain things has to be kept in mind. Whether technical know-how has an independent value, whether it can be used to separate even without that asset. That is one thing. It is having independent life, and if it can be depreciated separately, that thing has to be kept in mind. Or whether it has to be necessarily a part of that particular asset. Without that asset, both are complementary. Before these assets, this cannot be utilized. That thing you have to keep in mind. So if it can be utilized separately, then the life of the particular technical know-how has to be ascertained, and the technical know-how should be amortized over that period, the life of that particular technical know-how. If it is going to part of that particular underlying asset, it cannot be separated. Then that can be depreciated along with that particular asset. Then what is the issue? Why it has been referred to FRRB? the notes of accounts or the audited report has nowhere that they have declared or disclosed what is the nature of the technical know-how, whether it has a separate life, that is life is along with the plant and machinery. These things have not been disclosed in the notes of accounts because the value was so high. So that's why they picked up this case to know what has happened, right? Okay. So copyright right of way. Now the pipelines are being laid in between agricultural farmlands. We have a lot of issues going for rounding, going because of for this gas, water. They get the and some places they acquire the land. Some places they take the right to use the land and they pay some amount to the owners. All these things are happening. What happened in a company was like they have taken the right of way for laying pipelines and that is being capitalized because it is for quite some number of years. So they are given the accounting policy as the number of years are more, we are not amortized, we are just capitalized, we are not amortized the value of that particular cost. So what the standard says is, yes, you may be having quite number of years, but it is not infinite. So whenever you get a right, it may be for 20 years, 25 years, 30 years, 90 years. So maximum you are taking 99 years as a lease. It is not infinite. You have a specific period. Though it may be a longer period, you are supposed to amortize it. You cannot keep it as a, because what will happen if they keep it as an asset itself? See, that asset is not going to depreciate. Land is not going to depreciate unless otherwise there is some natural calamity, not going to depreciate. Generally, land is so. Keeping that cost of right away, what has happened? But you don't have a tangible asset for it. You don't have a tangible asset for it. At any point of time, that land belongs to some other person. Once that period is over, he may ask you to vacate it. Maybe renewed or not renewed, he may ask. So whatever you have spent for getting that right has to be written off on a best judgment or during the life of the particular thing that management has to analyze and take a call on it, right? So in one of the case I highlighted, I will not go deep into this. They have used the term as put into use. That is, that asset has been recognized only when it is being put into use. So AS10 and AS20 both says wherever the asset is ready for its intended use, that is available for use, it has to be accounted immediately. You cannot postpone it. So that is the thing here that policy taken was when it is put into, which is wrong. That's why that particular financial statement was referred to FRRB and explanation was sought from the professionals, right? Research and development. There are two pages. One is research and development. So the standard very clearly says earlier we had AS8. When we are studying for our intermediate, we have called as AS8, which talked about research and development. So earlier there was some lot of, if this is like this, you have to do like this. If this is like this, you do like this. A lot of permutation and combination are given in AS8, research and development. When AS26 was introduced in somewhere in 2004, AS8 was withdrawn. That was clubbed along with AS26. So when AS26 came, they made it very clear whatever expense that you are doing at the research phase should be expensed immediately. That means that has to be taken to the P&L account immediately. You cannot capitalize it. So there is no option for you. If you are doing a research, you don't have an option for you to capitalize it. You have to expense it immediately. In case of a development stage, they give an option to the management. They want to look into two aspects, whether this development, so research is success. When they will go for development, only if the research is success, they'll go for development. So when it is in the development stage, again, they are asking the management to look into whether this development will be a success or not. If the management can demonstrate with evidence that this development is going to be a success, then whatever you spend for development can be capitalized. If the management is unable to demonstrate that the development phase will be a success, then whatever cost that you are incurring for the purpose of development stage should also be expensed in the P&L account. So what is the difference that is going to make if I'm going to show it in the P&L account or in the balance sheet? If it's going to be in the balance sheet, I'm going to get it over a period of time. I'm going to take it to the P&L account. I'm going to straight away get it this year itself. That is, in a way, it is if I'm going to take it to the P&L account, in a way, it is beneficial for me, so that I can pay reduced tax. So tax amount should not be the only element that you should have in mind. Yes, you may be paying a little bit reduced tax, but you have to keep in mind your profit has also come down. If your profit has come down, then it will be difficult for you to raise more finance if you need for your business. So if that is the case, you have to be very prudent. You have to follow the standard, and you have to ensure that the classification has been done appropriately, right? With this, I just conclude my presentation, and I thank the participants who have come physically as well as who are attending virtually through Zoom for patiently hearing to my presentation. And once again, I thank my co-speaker, Mr. Manivel. We both were constantly discussing what to present, how to present. So to be very frank, this is the first time Mr. Manivel is presenting to the members. Hopefully, he should go up in the years to come. I'm sure he is also a faculty for CA students. I'm sure he'll come up very well in the days to come. And I always thank my seniors in Salem, my senior chartered accountants, my peers, my well-wishers, who have given me the encouragement to come and stand in the podium and to deliver. So I fondly remember Sridhar sir, he called me day before yesterday. As soon as he saw my name in the list of speakers, he called me and congratulated me, Narendran. I'm very happy to see your name there. To be very frank, I am here after 10 to 12 years. At the time of qualification, I used to make a lot of presentation because of courtesy of my senior mentor, Mr. Sandana sir, who used to take me everywhere where he goes for a presentation. He gave me the confidence, and later on I was able to do for 4 or 5 years. Then due to professional practice, due to some other reasons, I could not come down. And Shankar made it a point that I have to come here today. So he just gave me only one option, whether it is on 30th or 31st. You decide and tell me, Anna, whether you are coming on 30th or 30th. I said 31st. He said, okay, then call me, Anna, 31st is not possible. Can you come on 30th? He said that he's having some other program. நான் சரி தலை கொடுத்தாச்சு 30 இருந்தா 31 இருந்தா அவ்வளவுதான் ரைட் ஓகே தென் we just went ahead. So I thank the management committee of Salem branch once again for giving this wonderful opportunity. Thank you one and all. Thank you.
So thank you very much, sir. On behalf of Salem branch of NCRC, I render my vote of thanks to Sri Narendran sir and Sri Manivel sir for this wonderful session on accounting standard and not in practical guidance. Thank you very much. Thank you very much.
சரி நான்
The next meeting will be telecasted at 2:15. Auditing standard by Tamil Amudan. Thank you.
Thank you both of you.